Welcome to the Broken Pie Chart Podcast, episode 264. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, Jay Pestrichelli, CEO of ZEGA Financial. Did I say ZEGA Financial twice? I don't know. How you doing, Jay?
Okay, you could say it as many times as you like, Derek. Welcoming me back is always, you can overdo it. It's totally fun.
Well, you and I were talking about Bitcoin. I'm going to do some quick hits today. And I'm not going to take a loss on Bitcoin. I'm just going to say that I heard an interview with Michael Saylor that you forwarded me, and I think he has some interesting points. Let me play that real quick.
Go ahead.
It's another great question, Andrew. A lot of times the skeptics, they say Bitcoin looks too good to be true. It's so good to be true. Someone's going to take it away from you. And that's based on a fundamental misunderstanding about Bitcoin. People refer to it as currency or digital currency, and that's unfortunate historical artifact. It's not digital currency. It's digital property. And once you make that big leap and understand it's property, you see the compelling use case is capital preservation for everyone in the world. There's no anathema associated with owning property. You can own $1 billion building in New York City. You can own every place in the world where they allow you to own property, which means China, Europe, the US, they're going to embrace Bitcoin as digital property.
All right, Jay. I agree with him.
What?
It's not a currency. It's not a currency.
You do agree with that part. We've known that part. And it is interesting to hear him say that. That's true.
Yeah. I mean, honestly, I love the fact that and this is coming, the audience knows this. I'm a Bitcoin skeptic. But I'm like, okay. I'm good with that explanation. It's property, much like if I bought a 1980 Topps baseball card set. The whole idea is it's property, and you buy something that's property because you think, let's say you're not using it, but you believe you can sell it to somebody else at a higher price later, or it will keep its value. So I'm okay with that. I know it might shock you to be like, oh yeah, I agree with what Michael Saylor said right there.
I'm glad you say that. And when I think about how I use it, I just hold my Bitcoin. Like I don't trade it. I don't use it to buy anything. You're right. I kind of hold it. And, I continue to be impressed with him. I think I told you I met him maybe it was about a month ago. You went to an event that he was talking about Bitcoin. So I would tell you that, he brings up later on in that interview that you can't use a piece of your building to buy a cup of coffee, right? So your property isn't your currency, isn't your mode of transaction. So, as a little bit of a store of value, can I get you to get to the store of value hurdle? Store of value? Okay. Maybe not so much. We're getting close. If I got you to property though, it's you're just a lick away from saying store of value. But it is an interesting way to look at it, and you have it, you hold it, it's value for you. It's something that you just own, right? And I think his theory, about it's worth it to take, which also in this interview, it's worth it to take, like when you buy a home or a building, to take a loan to buy Bitcoin. And I think you and I both cringed a little bit. We are not suggesting people go into debt to buy Bitcoin, but Michael Saylor does. He borrows money on his balance sheet, using his balance sheet to buy more Bitcoin. And when you look at, by the way, you're wondering who's Michael Saylor. If you don't know who Michael Saylor is, he is the CEO of MicroStrategy, ticker MSTR. We have a fund that trades that includes MicroStrategies, but that's not why we're focusing on it. Well, the reason we're focusing on it is this week his stock was up 25%. Not bad. The week before that, his stock was up over 30%. So if you look at a chart of MicroStrategies, it's certainly interesting. He would say he has leveraged exposure to Bitcoin. So if that's your cup of tea, then there you go. There's ZEGA. That is not for everybody. It's a highly aggressive stock, highly volatile stock. But he really has transitioned that company to be more from going from a software company to now more of a focus on crypto and services in crypto. So there you go. Michael Saylor, thank you for playing his interview. I love the fact that you've given some you've given in a little bit to your defiance of Bitcoin. So
No,
great job.
he just admitted what I've been saying all along. It's something that you buy because either you believe that it will keep value or that it will go up and you can sell it to someone else later at a higher price. And right. So, my 1980 Topps baseball card collection, same thing, Jay, as Bitcoin.
Yeah,
exact same thing.
Oh, surely a little bit of water is not going to ruin your Bitcoin, but that's besides the point. But
well,
I think, yeah. So you never know. Who knows what the value is going to be, right?
I don't know.
5,000, it could be $1 million. I don't know. So
it is interesting, though. Eric Baltunas tweeted out from Bloomberg. You've been on the air with Eric, right?
Eric's a great guy.
Yeah. So he tweeted something out, year-to-date 2024 category ETF flows. And it looks like spot Bitcoin, so GBTC, was the number one year-to-date flow. And if you look all the way down,
I think that's an example. GBTC has lost, but its IBIT is picked up.
Oh, right. Yeah, that's an example.
So, right. So just
Bitcoin ETFs.
Greystone, Grayscale. Sorry.
Yeah. Okay. Although they have spot Bitcoin listed twice. You see below investment grade?
I do. I don't know.
I think Eric tweeted this out. Anyway.
Good job,
Eric. Gold and commodities so the money's coming out of those. So
yeah, and this is for the year, right? So you're talking about the most inflows into ETFs went into spot Bitcoin ETFs, but the most outflows came out of commodities and gold. I find it interesting with gold kind of hitting a new high. Let me look at the chart of gold for a second here, right? While a little pullback the last few days, gold has had a nice little run in and of itself. So, yeah, that's some interesting data there, Derek. I don't know. Is it bubbling? Maybe. Look, Bitcoin has had these runs in the past and has had, dramatic declines as well. Multiple times, Bitcoin has dropped 80%. I just said it. Multiple times, more than once. Bitcoin has had a period of time where the pullback was 80%. Of course, right now, I think it hit an all-time high this week. It's so far to date, it has always recovered, but who knows?
All right, I think I've gotten to my limit for Bitcoin. For a podcast.
I can't believe you even brought it up. I love it. Good job. Good job. Way to grow as a person, Derek.
Well, all right. My growth continues. I do wonder though, are people pulling money out of gold to go into Bitcoin? That seems like a leap too far.
Michael Saylor would say it's digital gold. If you find that interview on Twitter, you'll
way more volatility though, and it's not time tested over history. But all right, we'll come back to that, or maybe not. Home buying prices, Jay. This is from Redfin, and it looks like.
Speaking of property, that was your transition. You missed the perfect. Speaking of property, let's talk about home buying.
Next week I'll write that down for next week. As of March 10th, what is this? Housing payments are up 7.3% year over year. Mortgage payment on a 4-week rolling average of the median asking price. Okay, so what's the median price of a house? And then based upon, this is at 30-year mortgage, probably at 6.88%. Your median payment is $2,686 a month. And people can't see the chart, but last year at this time was $2,500. In 2022, it was $2,000. And then you go down to 2021 when interest rates were much, much lower. Jay, I'm going to eyeball at about $1,600 or so. So basically today, 2021 for the median price house, and the median price is up, by the way, but you'd spend $1,600 a month. Now it's $2,686 a month. So I bring this up because it goes to sort of, I know everyone's talking about inflation and the rate of change is going down, but interest rates going up, Jay, as you and I have said before, the Fed is actually causing costs to go up.
Yep. And this is if you were to buy the median house, right? This is not. So when I think about what in fact people are truly paying for those median houses, I don't think there's a lot of people getting mortgage rates at 6.5%-7% right now. Right. So when I think about this is like it's an if you were to buy, but if you bought your house 5 years ago, you're your payments haven't gone up. Maybe and you bought the median house 5 years ago, and now you're still the median house. Your payments haven't gone up. So this is if you wanted to get into a new median house. Am I correct about that, David?
Yeah, I believe so. Yep.
Yeah. So, okay. But at some point, people are going to have to buy houses again. I get it. But not a lot of people are doing it unless they're forced to do it. So I think this is certainly, we have talked about this multiple times, how the cost, to pay for your shelter is something that the Fed is impacting. By the way, conveniently, they don't include that in their inflation data point, PCE, right? It's in CPI. It's not in PCE. So I guess they're aware of it, but they're like, we know this is what we impact. We should take it out. And that's probably right for good and bad reasons, right? It sometimes could hurt, sometimes could help. I think taking that out because that is something they know they absolutely directly impact.
Yeah, I would agree. All right, let's switch to U.S. deposits at commercial banks plus money market assets. Jay, we were talking last week about money market funds. This is a chart showing this is the ICI money market fund assets. Okay, so this we've got one line showing money market funds going really, it's accelerated up. And it looks at small domestic commercial banks, large domestic commercial banks. So this is, assets at the banks, foreign related institutions, and then money market funds. You can see, 2020, the helicopter drops money out of the sky. You can see everything went up. But commercial banks and large commercial banks have been losing based upon this chart here. I would say deposits or assets, but money market funds keep going up and up. So I don't know. Is this coming out of banks or is it just money on the sidelines? Like, are investors still on the sidelines here and they're going to come back in at some point? Or is this just rotate out of banks?
I mean, there's plenty of cash here. That's a really interesting point. And look, I'm not surprised that the large domestic banks are losing assets to, the smaller commercial banks and even money markets. Why? Because they continue to not pay you what your money should be earning you. You've criticized me multiple times for leaving my money at JP Morgan because I'm not earning anything. And guess what? I still have money at Chase. But nonetheless, I moved it to money market. Finally, some of it, Derek. But so I think this is the fact that, they can be more competitive and what they pay out is great. I do think, though, this is quite a bit of money on the sidelines. You could see what happened after the pandemic year, 2020, as that spiked. We all know what happened to, I'm not saying there's 100% correlation to what the market did in 2020 and the rebound and what flowed through to 2021. But, this is one of those wind at your sails. The wind is behind you. Wind in your sails, whatever's making your boat go faster. This is one of those things that is, wow, really blew that. One of these days we'll do an edit.
Yeah.
That really is pushing, that is keeping.
The wind's at your sails.
Thanks. I mean, I don't, Derek, we talked about this, a couple of days ago at our investment committee, like the way that the market is moving, right? Up and to the right at a significant angle, and every little dip is bought. We haven't had a 2% pullback now for months. This is a little unusual, and things like this are the reason why people are just waiting to buy, stocks on the cheap if they can get it. Like if I told you tomorrow, Nvidia you could buy Nvidia at. Sorry, I picked on Nvidia. I know we always talk about Nvidia. Sorry, let me pick another one. Let's just talk about it because it's the hot one to talk about.
Yeah.
If you could buy Nvidia at 600 tomorrow, would you, if it went down to 600, would you buy it?
I think a lot of people would.
I think a lot of people would. Meanwhile, 600 was considered the top just 3 months ago, right? So it used to be significant resistance and considered expensive. Now would be considered cheap. So it's just that dynamic and that the psychology of all investors, where when you think you could get something cheaper and you have money on the sidelines, you're going to hop into it because you're like, wow, I may never see 600 again. By the way, I don't know if that's true or not.
Who knows? Yeah. By the way, it's a good idea when people buy on pullbacks. It's a good idea only in hindsight if you know it went up after. If it goes to 400, you're like, all right, well, maybe I made a mistake.
Well, that's it. That's
that's the game we're in,
What?
So,
I didn't know. It's
yeah.
okay. Can you go down more?
By the way, Jay, I'm going to buy you a T-shirt with a picture of the Dos Equis guy, and it's going to say, I don't always earn interest, but when I do, I earn it 0.01%.
And yes, and I'll get a nice beard and mustache. I'll be the world's most interesting bank investor.
All right, switching to let's scare some people. Let's go negative for a second.
Yeah, but it's not all roses. This sounds great out there right now.
Well, this is the great thing. If we were actually media, we would just scare people all the time to get ratings. We don't do that, but here's something, if you want to look at coal in the stocking, advanced retail, and food services sales. This basically is you take retail and food services, but you adjust for inflation. So real, of course, for the audience means, if you grow your sales by 10%, but inflation went up by 10%, you actually didn't have any growth. The prices just went up. So this sort of crested in April, I'm going to say April of 22, and it has been trending flat to down really since the spike, I guess, in 21. And what's interesting about this is typically when you see this trade sideways, it trades sideways and then you get a recession. All right. Does that mean we're going to have a recession? Who knows? Well, in 29 out of 30 economists would have told you at the start of 2023. So who really knows?
I think you would admit at some point we'll have a recession there.
Well, at some point we will. How's that?
There you go.
I don't know. Is this anything? I mean, I do think it's...
Yeah, it has been sideways for quite a while. The last time it's been this sideways was like 2006, 2007, leading into the 08 sell-off. Now, of course, that was, more of a real estate and property recession that caused, so many other things to collapse. But even if you go back to, say, the dot-com era, the 2000 area, right at 2000, this got sideways as well. So, I think it's got some weirdness in it, obviously, because of, what happened in 2020. And then we got this interesting, really big run up after everybody was kind of held back and couldn't spend money. You weren't even allowed to go out to the store, right? We all remember this. So now that's all kind of popping up. And so the thing here, though, about retail and food services sales, I mean, this includes, your Amazon's in here, right? Amazon, your deliveries are in here. Your I'm trying to remember now, your Instacart is all in here, right? So for that to be going sideways means people are really spending less, not spending less, spending the same. I just, Derek, as I think through this, I would say I would love to see this in a period of high inflation to know that, yeah, people understand they're paying more for a dozen eggs, but they're still buying the same amount of eggs. I don't know. I'm not too scared about it, but it's certainly something to take a look at, that maybe corporate earnings could be impacted by something like this.
It goes to margins too. Maybe at some point the units sold goes down, but the revenue stays the same, but their earnings. I mean, that would be if you triangulate back to it. I do think it's interesting, by the way, that it's funny, and then sometimes I know you do it too. I do it. When we talk to people, you're like, okay, quarterly GDP is actually real GDP. We don't call it real GDP. We just call it quarterly GDP, which of course is annualized. So if it's at 4%, theoretically it's at 1%. Back of the napkin, and retail sales comes out. They do not do real retail sales or adjust for inflation. The one you see on CNBC is nominal retail sales. And, sometimes like China, they report their GDP. They don't annualize their quarterly, believe it or not. So, all these different measures.
I don't believe a lot of the data out of China. How's that sound?
Well, whether you do or you don't, they don't annualize it. So if their quarter over quarter was 1%, they'd report 1%. Whether it is or it isn't, that's another story. But, we would report it as 4%, or, whatever the annualized is. So, all right, let's watch this. let's also watch. We got to talk about. You mentioned Nvidia. I think Eric Baltunas also tweeted this out. This is SMH, so the Semiconductor VanEck Semiconductor ETF, not an endorsement or it's not really endorsement, not a recommendation or endorsement. We just buy the market, we hedge, we buffer, that type of stuff. The fund flows in millions. Like this went parabolic this week.
Yeah, I mean, it's not even on the chart how many dollars have flowed in to semiconductor stocks as rated by this SMH. Like, it's not even close, right? The amount of money flowing in to semiconductors is kind of unprecedented. What they don't show on this chart, sorry, Eric, is what happens after you have these spikes. There have been spikes before, right? 2022 looks like there were some spikes in 17, 18, 19, higher than average, and then you get this pop after. Interesting though, Derek, right? 2022, their largest spikes happened in the first third of the year.
Mm-hmm.
That didn't help anybody too much in 2022, did it? So, I mean, at least that's where investors were putting their money. You've talked about putting your money in, you've talked about semiconductors for a while.
Oh, full disclosure, I have, I'll talk about your book, Buy and Hedge. You talk about the inner guru, your own pie chart. Also, I wrote a book called Broken Pie Chart. Both great books, great books, Easter gifts. Get them on Amazon. But this is, and you do the same thing. Like it's not the core thing we do, but yeah, I own semis. I've owned them since October of 22, I think, and sometimes you luck out, sometimes you don't. But yeah, I mean, these have been in the news for sure. Don't buy them because I buy them. If you want to buy semis, buy them. If you don't want them, don't buy it.
Semis. So help people understand, because some people may not know what
semiconductors. Yep. So
what does that mean?
Chips.
Computer chips.
Computer chips, whether it's a computer, your car, God, these days, your phone, your
microwave,
vacuum,
your refrigerator.
They need computer chips to process stuff. And for artificial intelligence or AI, doing those really complicated and powerful computations, you need really big servers and GPUs and all that. So, all right, but back to the flows. It's fast. I don't know if this is a tell. The contrarian would say, hey, they just brought in 1.6 billion, double its old record. Is this signaling a high? Well, no, we know, but like semis didn't just go up yesterday. I'm like, really? All this money just came in?
Listen, sometimes buying at the high just means, it can go higher. Buy high, sell higher. Somebody's book. That's the name of somebody's book.
It ought to be. Yeah.
Yeah. But look, it's great. I mean, this is pure tech, right? Hardware tech. This is companies like Texas Instruments are in here. Intel is in here. It's not all NVIDIA, right? It's anybody that's making the chips. So I think, look, and there's investments that are being made into the space, right? America's trying to bring back the foundries to onshore instead of offshore. I don't know what you can have these days that doesn't have chips in it. So, there's clearly it's catching on. If you own the Qs or the S&P, you have exposure to this.
There you go. Yeah, I'm glad you brought that up. So people should understand that, Jay. It's like, yeah, if you index, you already own some of this stuff. And you own more as it's been gaining momentum because it's weighted, its weight within the indexes go up, right?
Yeah, I mean, that's the way this happens, right? So we've gone through that many times, but to your point, the weighting increases. Yep.
Let's talk a little bit about the hot PPI that came out, which is Producer Price Index.
Not great.
And yeah, I mean, basically stuff. So the widgets that companies need to make stuff is costing more. But I actually isolated the PPI finished services, less trade, transportation, and warehousing. That's a lot to say. Audience can't see this, but if we look at a chart of this, it's sort of the services side is reaccelerating, and it's nowhere near down where it was, going back to 2019?
2020, yep.
Yeah,
and we're in the high inflation rate zone here, right? We're in where 2021, now sometimes, Derek, people would say PPI leads CPI, right? So what it costs for you to make something, for you to make a widget, you got to pay that, then you make the widget, then you have to sell it at a higher price. Well, there's a lag there. And so when you look at PPI, when it really did kind of spike out, it was the December of 2021, right? That's when it was the highest here. And so then we all know what happened in 2022 with CPI, the Consumer Price Index, what we pay as consumers, not versus what companies pay to produce. So, there's always been a lag. PPI leads, and PPI, it was projected at 0.3% for the month, came in at 0.6. I think that was the number. It was a surprising number. And so why do we care about this, right? The reason why we focus on this, and we've talked about this a few times, if inflation persists, the Fed will leave rates higher for longer, restrictive longer. They will try to reduce economic activity, right? They will try to slow down the economy, and supply and demand rules, all those kind of great things. But I would say if CPI stays high because PPI is high, you should expect, generally speaking, the Fed to have a lower chance of reducing rates throughout the year, right? That's the general gist. And this is a scenario where this is bad news. And how did the market react on Thursday? Badly.
Not great.
Badly. Yeah. So bad news is bad news. I like a market where bad news is bad news. At first, by the way, the number came out, future spiked. I was like, what has happened? Spiked up. I was like, what is happening here? This is a terrible number. How could we be up? And of course, market open. And then, it seems like the bad news is bad news. People ended up hammering the market down. But it wasn't awful, but we did, we were down over 1% at some point during Thursday. So, not good news. Wow, 2 downers. You brought 2 downers to the table today, Derek.
Well, let's bring another one.
Let's bring another one. Okay.
I always like when people make prognostications that we're about to have a worst crash since 1929. So universes.
So worse than the pandemic. Okay, let's hear what he has to say.
Yeah, well, this is the Black Swan fund manager, Mark Spitznagel, expects the stock market to rally further before we hit the worst crash since 1929. And, they run, I guess we'll call it, a tail risk fund. And it's a hedge fund. So it's not like, you can't necessarily pull up the returns. And yeah, I don't know. Anything here?
Okay, so a Black Swan fund manager comes out and says, guess what, guys, the worst crash since 1929 is coming. That's what happened here, right? That's what we're looking at. No kidding.
That's right.
Well, look, I don't think this is manipulation at all. I didn't say that, but I would say, his bias and his fund is there to profit from a major sell-off, to profit from a Black Swan. I will read the article. Thanks for sending it over to me. I didn't read it before the podcast, but look, this is why we hedge. I don't know when there's going to be a Black Swan. We could be completely whistling past the graveyard right now as we talk about, all-time highs again. Did I get to do a tick mark? I didn't actually look. We did not touch a new high. The last time we hit that high was on 3.8. So we did have a closing high, which was on the 12th, which was, we did have a closing high, but didn't touch a high. So another week, another high. We could be whistling past the graveyard here and not knowing what's going to happen. We're not taking hedges off, right? Actually, we like re-hedging at new highs because maybe this happens. Like maybe this is right. I don't know when there's going to be another major, quick, fast sell-off that happens before anybody get trade out of their positions because you don't know. Because when it happens fast. Now, I think you and I would argue that in the short near term, when you read some of the tea leaves with the VIX, and we've talked about, credit spreads, when you look at those things, there's nothing flashing red. But, there was nothing flashing red in January of 2020 either. There was nothing really flashing red. I'm trying to think of another time. In 2011, right? 2001, September 2001. I don't know when those kinds of things are going to happen. And so for folks that have, long-term plans, you have to expect at some point you'll have a pretty dramatic sell-off. It doesn't feel like that's happening tomorrow. But again, I don't know when it's going to happen. Derek, I remember we talked about, I remember January 2020, we were talking a lot about, what's this Chinese thing that's coming, and what is it all? And I think we had, we all discovered the flu actually kills people. Nobody even thought the flu killed people, right? Until maybe this will just be like a flu, which by the way is the way it feels now. But at the time, nobody really understood the impact of what this was going to be. And so, you don't know when one of those black swans are going to come out. And, it's not going to be helpful, but generally for people that are investing, it causes you to lose some years of growth. However, if you hedge, you get to avoid some of that. It's one of the reasons why we hedge. Really, make sure we hedge the broad-based exposure of anybody's portfolio.
I'm not sure that prognostications like this are helpful, and it's not picking on this individual, this fund manager. And whether you go back, you Google any year, you do a Google search go into Google and limit your search to a certain year and type in market crash, and you'll see the same people making the same prognostications again and again. Who's the one guy? Is it Harry Dent? Is he the one who's always like, we're going to be, the market's going to zero? Is he the one?
I don't know, but now all I can think is Harvey Dent, who is Two-Face from Batman. So I don't know. Now I'm distracted.
Did I use the wrong?
I don't know. I'm not sure.
Dent, Dow crash. I'm going to Google this. I don't have my Harry Dent.
All right, it's Harry.
Oh, okay. So I just did a Google. Harry Dent doubles down. Major crash for equities coming, I guess. That was in February. 90% economic collapse is coming. That was 4 weeks ago. So here, I'll do this live, Jay. If I go into the tools and I say custom range, and I'm going to do 2013 to 2015, and I'm going to hit go. Let me see. Harry Dent crash.
While you're doing that, I'm going to read one line from this gentleman's interview. He said, well, my simple reasoning for that is that we are witnessing the bursting of the greatest credit bubble in human history, and crashes are direct consequences of bursting credit bubbles. So he's talking about a breakdown in the credit markets, right? That's what he's talking about here, causing. And of course, if that was true, it would absolutely, hit the equity markets as well, right? Stocks would, if something like that happened, that's true. I'm not saying that he's right, but he said that's what we're witnessing.
Yeah.
With the that's the second time I almost said manipulation. With the way the Fed has been managing balance sheets and managing interest rates, we don't have a Fed that's hands off and let the chips lie where they may. There's way too much control that the Fed has to intervene if things look like they are going the wrong way. So, just something to. Maybe this would have been a different case in the 70s, but it doesn't feel like that's the way it is today. All right, what do you got on your Google search?
2015, let me see, produced a video in April that went viral. He's predicting the greatest stock market collapse since the Great Depression, June 16, 2015. So, all right, there you go. I mean, this is what I'm saying. Like, just pick a date and Google market crash. And I put his name in because he came to mind, but just put it in. You'll see this again and again. Like, it's not helpful. You're not helping people by doing this. I'm sorry. And, it's troubling. All right. Why are we being so negative on this one?
I didn't start. I was happy until you started with this stuff.
Well, we'll get happy when we're going to talk some options data.
Okay. All right.
Zero DTE options. We'll do that. Before I do that, I got to tell you that the tech bubble. So I did a Bloomberg search where I did in quotes story count for the term tech bubble and grabbed a chart of this. I know you can see it. There we go. The market's closed again an hour later. Did you hear the bell? Or no?
That didn't come through.
Okay. Yeah. Arizona, our systems sometimes don't know when to ring the bell. Tech
Nobody
bubble.
knows what time it is in Arizona. What's the matter with you?
Nobody knows.
Nobody knows.
We're Pacific time.
Oh, it's lunchtime. There you go.
It's a little bit after lunch. So I just thought this was interesting. I have a chart of the Qs, so the NASDAQ 100, of course. And then it also plots along the story count for specifically the term tech bubble. And there's a lot of mentions of it in 2020. And, it doesn't go back, it only goes back to 2014, my search criteria. I couldn't get it to go back further. But I bring this up because you think, people searching for or talking about in the news tech bubble means one is imminent. No, not really.
That's the point they're going to make. For those that can't see the chart, when these mentions of the tech bubble and stories happens, it is not when the market is at a peak, right? Actually, it looks like it precedes, further growth. I'm looking at the 2020 numbers. I'm looking at those pops in 2017, right? 2018. It doesn't tell you oh, it's the hot topic. It's almost weird. It's not the contrarian indicator that you would expect. It's not the cupcake indicator, right?
No.
What do you call that? The cupcake.
That's when your local news, right after we make cupcakes with Arizona cactus juice, we show a chart of the Dow in the corner. That's when the market's bottomed.
That's the bottom. You buy when the local news is talking about the market.
No, they have the chart of the Dow, and of course they use the Dow, not the S&P, but they have that in the corner.
Cares about the Dow?
But they have it the entire show. It's they literally put the little cutout there. When that gets to the local news, it's bottomed.
Dirty Laundry. For those that don't know that song, Don Henley. So
Don Henley,
yeah. All right.
Also, and what I like about this little search on Bloomberg is there's a difference between people like, oh, the crash is coming, or the tech bubble and all that stuff. But sometimes you see it, like I did artificial intelligence, stories about artificial intelligence count, and I did it against the VanEck Semiconductor ETF. Not a recommendation, and you see semis had sort of bottomed in September, October of 22. And it just started the beginning of 2023. The mentions and news stories of artificial intelligence start to spike. And so semis started to go up in advance of that. But that's different. Like if you get to a story stock or a narrative, like it doesn't matter if it's semis or anything else. Like as narratives and momentum build, you can actually see that start to propel things higher. Would you agree?
Yeah, because all of a sudden people become aware of it. Like, oh, should I pay attention to this? Like, oh, maybe I should buy some of this. This is something interesting. AI it's been around for a while. They've been working on it for a while. It's just, there's a little better use case today than there was, say, 2 or 3 years ago. But, people have been talking about AI for a long time, and now it matters. I don't know if it's the tail wagging the dog here, right, Derek, where did it matter? Because are the stocks up? And then people say, well, what's driving the stock market? Oh, it's AI. And then people hear AI, so they want to buy semiconductors. Like, I don't know which one, chicken and the egg is coming first here. But I do think that awareness and what's causing the focus certainly causes appreciation in the markets. I mean, you talked about Bitcoin earlier. You talk about AI now. I mean, I don't know. Are there any two topics hotter than that right now? Where to invest? I don't know. When the news comes out about something else, this is a great search to do. You could watch, and you watch the trends. So, we'll see. When, nobody really picked up on your, was it the cocoa futures that you were talking about that were so high and they were spiking a few weeks ago? Strangely enough, I didn't hear a lot of other follow-up from the media on that, Derek. Sorry.
All right. Well, you got to, if you look at Cocoa World Today newsletter, as I'm sure I remember I found
right here on my desk.
I can't remember the name. You still make fun of me for reading Freight Waves, which is the logistics and container shipping.
Send emails in making fun of Derek for reading Freight Waves.
Yeah, send those to derek.moore@zegafinancial.com. That's derek.moore. Z is in zebra, E is in Eddie, G is in George, A is in Apple. Financial's up to you to get right. Okay, so let's go to NVIDIA. You mentioned NVIDIA. Normally, we know in the options market, Jay, that options price in typically, and I'm using air quotes here, typically more of movement than a stock realizes. After earnings, when we saw a huge spike in implied volatility expectations, we've seen a flip, and the stock has moved more than the options market has been predicting. I don't know if this is anything. It's just something we notice.
Yeah, well, okay, so what does this mean? So we always talk about what the predicted movement and volatility is versus what actually happens. I was talking to somebody this week, and they said, oh, you should always sell options when volatility is high and buy options when volatility is low. And while that seems to be logical, the real answer is like, well, it depends what happens after to see if you make money, right? If you're buying options when volatility is 15 and then the realized volatility of it is 12, you overpaid, right, for something that happened. If you expected the market to move 1% a day, but the market only moved 0.5% a day, you might have overpaid. And same thing goes the other way. Hey, if you sell options and volatility ends up being, higher, even though it was high, it could always go a little higher. You could find yourself on the wrong end of that trade. And so when I look at this, so there is a lot of volume, a lot of retail volume, a lot of individuals that are trading NVIDIA calls and puts. Why? Because it's so darn expensive to buy a couple shares of NVIDIA, right? At $800, $900 a share. So people trade the options. I'm not saying that's what they should do. I'm just saying that's what happens naturally. That's one of the things about options. And so, yeah, Derek, to see that there is more historic volatility, meaning the market is moving more than people are willing to pay, tells me that some folks think, hey, the options are high, I should be selling them. And then the market continues to move higher. Like, this has been a very interesting performance, the way that the stock is traded. But it's trading really well. It's not like, $2 wide bid-ask spreads. It's trading tight spreads. There's plenty of liquidity. I'm not so bothered by the fact that the option traders are underpaying for the options. I'm not saying options are cheap on NVIDIA. I'm not telling everybody to go buy calls or puts on NVIDIA, but I'm just saying they're not expensive compared to what NVIDIA's 30-day movement has looked like. So, and it's not pulling back either, right? It's slowly trending higher, the volatility of NVIDIA. So I don't know. I think this is, if I had to digest what's happening in the options market, it's probably, some concerns that we should sell vol when it's high. And then they realize like, oh, it actually wasn't, it should be higher. So be careful selling volatility on stocks that have had runs like this.
I want to also I pulled up the 0 days to expiry options, and I did this afternoon. So there was probably only a half hour left when I did this, but I looked at NVIDIA and today's expiration. And one of the things there was just a couple interesting things I will highlight here. The max call open interest, and you've seen this already. But think about it. NVIDIA, when I pulled this, was about 887, so just below 900. I mean, I'll bet you if I polled the audience, nobody would get this. 500, Jay, is the max call open interest.
I mean, that means there's more calls at the 500 level than where it's trading around right now. That's what we're talking about?
Expiring today. So the open interest, which of course doesn't update intraday as of yesterday. Yeah, like there were calls, which essentially means you're long the stock because it's so far in the money.
Wow. Well, that's it's so far away from the current price. I find that odd. Like generally with call open interest, well, I'm gonna say why I was gonna say, and then I'm going to amend it with something I just said. So with call interest, usually you see a lot of people buying out of the money calls, being a little speculative. Hey, I could just pay $20, and if Nvidia just runs up to my strike, I'm going to be worth a couple hundred, like that kind of mentality. But Derek, I'm going to hope. I'm going to hold out a little hope here and say, that is a really inexpensive way to buy Nvidia for the day. Well, not really inexpensive. You're paying about, a third of the price, because the time value in a call that is so deep in the money is going to be low, right? It's going to feel like almost 100 delta position, right? Meaning you're going to get the ups and downs and movement in the calls as if you own the stock. So instead of paying $800 a share, you were paying $300 a share today. And look, take it or leave it, stock goes up or down, but it's a more efficient way. If you're going to day trade Nvidia and you're willing to trade 100, shares at a time, and you're willing to take that risk, I think it has a lot to do with that. I think 500 is a nice round number. I think people just kind of gravitate to the round numbers. There's probably a lot of open interest there. All of that being said, I think there's an explanation there. At first, I wasn't sure about it, but now I think that's what it is. And I think this is worth checking on every Friday when they have expiring options to see. Not giving you a test, but I'm just saying I wouldn't be surprised if that was the case normally on expiration Friday.
Let's move in ahead. Skip the next one, Jay. Let's look at the SPX, and I've pulled today's expiration, and then I've also got a screenshot of Monday's, March 18th.
Okay.
And what you find here is, so 0 DTE, which is the ones that just expired today. We're recording this on a Friday. And, the max put open interest was 17.75% below the current price, the 42.10s. So I did this when market was about 51.18. The max open interest was at 5,200, and the max call open interest was also at 5,200. Okay. So, the calls, it looks like a lot of the open interest was about 1.5%, 1.5% above the current market. Most of the puts looks like people had protection, unless they sold the puts, because we don't know. Open interest could be open to sell, open to buy. But the other thing too, the open interest as a percent versus the total open interest was only 5.73%. So I want that to sink in for a second, because we hear a lot of talk about how, zero TTE options or short data options are taking over or skewing the market. The volume, though, versus the total volume was about 49%. So let me repeat that. The volume in the options that were expiring today on the SPX compared to everything on SPX was 49%.
Okay, so let's understand what today is, right? Today that we're recording this, it's March 15th. This was the monthly expiration for March, right?
Yep.
This is one of those expirations that has had monthlies. These have been out for a while. People use these as they're spreading out their positions. So there's just always more volume on a monthly expiration day than any other single day. And then there's always more volume on the, let's say the January, the March, the Junes, the Seps, the Decembers, right? Just because those are the, options that are out there on the indexes. So there just is a lot more volume. And so, like you said, we don't know if it's buying or selling, right? Opening or closing of positions. But look, this is a busy day. We used to call these days witching days, right?
Triple witching, quadruple witching.
Yeah. So there's just always been more volume here. I just continue to refuse to make a big deal about the 0 DTEs. I think it's wonderful that we have an options market that's so efficient and is so capable to be able to handle all of the volume that it gets every day on options that expire at such a short period of time. It has really made the options market so much more interesting. Heck, Derek, we have funds that trade 1 day, 0 day options. If you're going to be active, you have to consider these, 0 DTEs as something that's in your playbook. And so I'm not, while it is remarkable, okay, who cares? Like, I'm trying to think, like, I know it's a change, so that's worth noting, but still, I don't think it has a negative or positive impact in the market at all. And every time the SIBO has done an investigation, they said, no, these options aren't, the tail's not wagging the dog. The options market isn't causing the equity markets to do something unusual. So I'm completely fine with this.
Look at the one for Monday's expiration. So these have not expired yet. These expired Monday, March 18th. So here, when I look at this and I look at where the max open interest is for puts, it looks to be either people have sold those or people are hedging and buying those, but it's about 18% below the current price of the stock. By the way, that max pain, by the way, so this is a Bloomberg chart, and they have something called max pain. Max pain, they show at the 51.35 strike, which is 0.35% above the price when I took this. And Jay, the max pain, I know you know this, but it's considering both call and put options across all strike prices to find the price level that would cause the most combined losses to all option holders, both calls and puts. So that's a little inside baseball there. But
Yeah, it's an interesting data point that they share there. So
yeah,
well, look, I mean, Monday is Monday, right? We're going to see what happens on Monday, but of course, if you're trading and you're trying to be a directional trader intraday, now you have these tools where you have options that expire every day. You don't have to worry about offsetting your time decay by doing synthetics that are out 4 days because you're like, well, I really want to trade today, but I don't want the time decay to burn me, part of that max pain piece. So now you just have a better tool to do it. And so, yeah, Monday's a lot less interesting than Friday while you're trading on Friday. I get it. So I'm not, it's interesting data, but this is the way that the world is going. Now, to those of you that want to start trading options and you haven't traded options before, look, they're speculative vehicles. Be careful on your sizing. When I say speculative, I mean they're naturally leveraged. Not all options are a speculative trade, right? So I misspoke there. But what I would say is just understand that they're naturally leveraged. One contract controls 100 shares. One contract of the SPX, Derek, controls over $500,000 of notional value, right? So if you're going to trade an option on the SPX, for example, which is the S&P 500 index, if you're going to trade that, you're trading $500,000. And if you're sitting there with an account with $5,000 in it, you are absolutely leveraging the heck out of your position. Be very careful. You want to reduce that by 10 times, you could trade the SPYs. Still, a SPY contract represents $51,000 of notional. So if you're sitting there with $5,000, you're trading $50,000. You're controlling $50,000 of market exposure. Be very careful. That could be high risk, high reward. We always stick to generally the fact that, hey, if I've got $50,000, I trade one contract, not 10, which is what I really could do if I had the cash. We don't like to use leverage. Be careful of the implied leverage when it comes to options, especially with zero DTE options. There's only so many days you could take a hammering on those, right? So be careful, understand what you're trading, understand your leverage. Options are naturally leveraged vehicles.
Well, Jay, it seems like we've run out of time to do my gamma evaluation of the zero DTEs. Maybe next week I will bring that in. By the way, notional value for the audience. Stocks trading at 100. You buy a contract. The deliverable is 100 shares, meaning you control but don't own 100 shares. 1 times 100 times 100. 10,000 is your notion.
10,000. Yep.
That's it.
Yep. Yeah, that's why. So that's why I was saying 50,000 and 500,000, right? Yep. The S&P trading at 15, SPY at 515 times 100. There you go. 51,000.
There it is. Well, we'll be back next week. Jay, any recommendations this week?
So I started Shogun. I'm liking it so far on Hulu. I like it so far.
Is it slow or is it? Tell me more about it.
No, it's good. I mean, setting things up right out of the gate, right? It's good. I think it's well done. I don't think that it's slow. So, I don't want to give too much away. I'm just starting.
No, don't give anything away. Don't give any.
All right.
Is it Succession level good, or is it like?
It starts off faster than Succession starts off.
Okay.
How's that sound?
All right.
Listen, Succession always had that great, build up, right? The last episode of every season was the wow episode, right? You had to put your time in. I'm enjoying Shogun out of the gate.
Okay. I got it on my list. I'm going to get to it at some point. By the way, if anyone hasn't watched Succession, that's always a recommendation for both of us. I mean,
top five show
on HBO. What do they call it? Max. How dumb was that? Like, why are they calling it Max?
I can't speak to the decisions at Warner Brothers and HBO and Max, and I got you. I don't know.
I don't think it's good.
Okay.
I still call it HBO. So
you're shorting Warner Brothers? Is that what you're doing?
I haven't even looked at their stock. I'm going to look at it right after this. I've been reading a book called The 90s by Chuck Klosterman. I've actually been listening to the audiobook because he reads it. And it's about the 90s, which you and I certainly were, formative years for us, right? College and starting work. So he has a part, I'm a baseball fan, but he crystallizes where baseball started to lose its luster, and it was the 94 strike. But it was also the steroid era, because baseball was unlike football, where you could always, look at stats from one era and compare it to another era. The steroid era just completely screwed that up.
Yep.
So kind of, and the 94 strike when they canceled the World Series. Not a good idea, baseball.
Sounds like HBO Max.
Yeah, a little bit worse than that.
Right.
All right, Jay, that's it. No, you don't want to stay for a second hour of gamma ratios?
Look, I could talk gamma all day, but as long as it's only talking about gamma radiation in the Hulk, and then I'm really excited about that.
That's it, folks. We're gone. See you, everyone. Have a good week.